Hi, and welcome to the Stock Scores Market Minutes for March 3rd, 2018. This week's topic, overbought, oversold. We often hear those terms, how stocks and markets are overbought or oversold. But what does that really mean? Well, when stocks go down too fast, or when markets go down too fast, they get oversold and are therefore ripe for a bounce up. When stocks go up too fast, they get overbought and are ripe for a pullback. It's really a question of where is price relative to the trend line on the chart. And it makes a lot more sense visually. So I'm going to show you some of the charts of the S&P 500 and really describe where overbought and oversold occur. So this is a 30-day chart, but as of last week, because I wanted to show a little bit longer look back. And there we had a linear upward trend. And anytime price ran away, it was overbought. And it comes back to the trend line, overbought, comes back to the trend line. When you're in a downward trend, and you can draw a line across the tops, anytime you run away to the downside, you're oversold and you come back. You could even draw another trend line like this. And then you get oversold again and you come back. And notice when it gets back to the trend line there, it stalls for a moment. And then it breaks the trend and we start a new upward trend. And we can say overbought, normal. We get a little bit linear here. That's not really overbought or oversold. And then we go into another situation where we move away from the trend, come back to it, away from the trend, come back to it. So in an upward trend, you are overbought when you've run up and away from the trend line. In a downward trend, you are oversold when you run down and away from the downward trend line. So let's look at the charts as they are for the S&P 500 as of right now. This is the 30-day, 60-minute chart. And you can see that we've had a fair amount of choppy trading in the last little while. We were trending lower. We broke that. We moved up for a couple of days. And then we broke that upward trend line right there. And if we draw that downward trend line, which is drawn across these tops, you can see that we got pretty oversold coming into Friday. And I told anyone who would listen that the market would probably bounce back on Friday simply because it was oversold and it needed to come back to that downward trend line. Now it is still negative in that very short-term time frame because it is trending down. Until we can break the trend line, we should remain somewhat cautious in the short term. Now moving on to the longer term, we can again draw the trend line and see that we got very overbought over the last few months, and then we've corrected back to the trend line, which takes out the overbought nature of the market. And then we ran up again, and that got us overbought again because we ran away from the trend line. At that point, we can draw a downward trend line, and we can say that right now we are in the middle. A little bit overbought because we have some distance to the upward trend line, and a little bit oversold because we have some distance to the downward trend line. What will happen in the next week? Well, given that we close this week above the open, that's why it's a green candle, we will probably fill in this space, but then we may come back and fill in this space later. That's my expectation near term. Moving on to the Russell 2000, which is the small cap market in the US. There is the upward trend line, and you can see that we ran away and we come back. Now sometimes it takes a long time to come back to the trend line. In this case, it took months. We ran away from the trend line. We came back with that little correction in the last little while, and we're now, I would say, fairly priced because we're sort of in the middle of that, what's called a channel. Okay. Onto the Canadian market. This is the 30-day, 60-minute chart. There was the upward trend line. It was broken early this week. We have now gone into a little bit of a downward move, ran away a little bit, came back to it. Let's see if we now break to the upside and go back. But in the general sense, this has been a sideways market for the last month. Onto the longer term chart for the Canadian market. There's the upward trend line, and that has been broken. So we've actually broken the upward trend line, and that's not really a good thing for Canadian stocks. It looks like more likely to come back and test this horizontal line of support right there. So if you can draw a straight line with a ruler and you know where to draw the lines, it becomes pretty simple to predict where the market is likely to go. Not where it will go, because we never know 100%, but you can be pretty good at predicting where it is likely to go. TSX Venture, this is a market that got heavily overbought in January. If we draw an upward trend line, it looks pretty much like that. Whoops, that didn't draw very well. Let me do it freehand, something like that. We really ran away from it. We came back to it. We bounced, and now we'll probably continue along in the slow grind higher that those stocks have been in. Now, the downward trend line looks something like that. We have to break through that, and for now it's kind of a neutral looking chart because we are in a situation where we're getting compressing volatility after a lot of volatility. Now we're compressing in the volatility, getting to the pointy end of the triangle. Onto the Treasury bond market, which for a long time this has been a very boring chart, and I often wondered why I presented it to you on a weekly basis, but it is an important chart now because the market's real concern of late has been interest rates. And if this chart is going down, that means interest rates are going up. What's important is that we have very strong horizontal support on this chart right about there. We hit it once, twice, 3 times, and we've now bounced off of it again. We're holding that. If we break down through this, that implies higher interest rates ahead. It breaks to some new lows for the last couple of years, and that will, I think, hurt the stock market. If instead interest rates hold and the bond market bounces up off of support, that means interest rates will go down, and that will be supportive for the stock market. So this is an important chart to watch. US dollar is been, I would say, stabilizing the last few weeks after some fairly strong selling pressure for, well, all of last year and into this year. And we are still in that downward trend. We ran away, got oversold, came back to the trend line. Now we're fair value. Then we ran away, and now we're working our way back to that downward trend line. So I think that there could still be a few more weeks of upside for the US dollar. But until it breaks the downward trend line, and it tried there and it got stuck, tried here. Until we can break the downward trend line, I want to be fairly bearish on the US dollar long term. Short term probably has some room to go to the upside. Well, that bearishness in the US dollar helps things that hurt when you drop them on your foot, as someone once said. These are the commodities, and of course the gold is probably the most famous commodity that people trade, and it is in an optimistic pattern. We are compressing in volatility, so there's less volatility in price over here than there was back in 2016, but notice that the bottoms are rising from left to right. That is a sign of optimism building. Until we can break out through that resistance level, I would not be a big buyer of gold or gold mining stocks. But in the months to come, if the US dollar does continue to get weaker, we could see that breakout through that ceiling price, and that would be a bullish signal for gold, which has been pretty boring for a number of years. And on to oil, something else that benefits from a weak US dollar. There was our trend line. We ran away from it, overbought. Keep in mind this is a weekly chart here. So this is going back 3 years. We ran away from it. We've pulled back to the trend line, and now we're trying to go again. Now this past week on the daily chart, we actually built a little falling top. So I'm a little bit concerned that we maybe retest this upward trend line. So I would call this a neutral chart right now. And finally, the fear chart. We had that big jump in fear, and then we fell back, and now we're getting a little bit of a jump again. But given how the market closed well below the open and well below the highs on Friday, I think we could see the market stabilize a little bit more next week, and maybe the VIX pull back a little bit. Still a very important chart to watch because it shows that there is a high level of fear in the market right now. So my rating on US and Canadian stocks, neutral on both time frames. Gold and oil, neutral on both time frames. Stocks continue to trade nervously and are losing their upward momentum. The upward trends have not been broken, but a falling top has formed, which increases the chance for a break of that long-term upward trend. Gold is building optimism, but it needs to break resistance. And oil is still in an upward trend, but it could break that trend, and I'm a little concerned again in the short term about that falling top on the daily. And as I said, fear is high. All right, on to the trade of the week. This is ECYT, and there you can see the action candle break of the downward trend line. That was the day that I bought it. And it took a couple of days, but it's really had a strong week. And it all starts with that show of abnormal activity, abnormal volume, abnormal price that sent that market higher. Well, that has been the Stock Scores Market Minutes for March 5th, 2018. Have a great week in the market and trade well.